And now we're going to be looking at the valley of growth, because growth is rarely linear. It is never guaranteed. The space between ambition and sustainability is where most ventures struggle. And it's where alignment between capital and leadership becomes critical. And so this session explores how founders and investors stay aligned on timelines, expectations, and outcomes, so growth isn't just achieved, but sustained. Joining this discussion are Khaled Attallah, co-founder and CEO of Ariika, Seif Hakim, founder and CEO of Alpha Global Enterprise, Ali Mokhtar, CEO at Beltone Venture Capital. We're keeping Ali very busy this afternoon. And moderating this session is Suzanne Knight, CEO of mBolden Consulting. Ladies and gentlemen, put your hands together for your speakers.
Hello, everyone. It is such a pleasure to be here with you moderating this wonderful panel. We have a limited amount of time, and I'm so excited to hear from our wonderful panelists. So why don't we just jump right in? And I'll start with the question. If capital amplifies whatever already exists, what is the one alignment that founders and investors must get right early to avoid scaling the wrong problems? So why don't we start with Khaled?
Okay, I think this is a very important question because I think we need to define, like most of the investors, probably if you talk to any investor, they want scale, they want speed. A lot of founders, they want, I would say, building a sustainable, meaningful business. However, finding the right spot or the sweet spot between investors and founders is very important in the beginning. And I think we need to agree on the non-negotiable terms. It might be unit economics, it might be distribution, it might be sales and revenues. So I think one of the key things for a successful collaboration or a successful relationship between the startup or the investors is to agree on the non-negotiable terms. So in case of Ariika, Ariika is one of the fastest growing direct-to-consumer home furnishing brands. And one of the lead investors that we have on board is Beltone, Ali Mokhtar. And I think I usually say that we're very lucky because this alignment happened since our first meeting, which is that we want to build a fast-growing, sustainable business, and we're not compromising on two important things, which is unit economics and customer experience. And since we agreed on this, I think we found the journey very smooth, very, I would say, we're growing in a sustainable way, and we're achieving what we want to do with the support of our investors.
That's wonderful. And maybe, Ali, I could actually ask you the same question, and specifically what you do to create that alignment.
I think I totally agree with what Khaled said. And finding the sweet spot between growth and profitability is the most important thing. I think currently the mindset actually shifted across all investors. If you go back in the era of 2017 till 2022, for example, which was everyone was focusing on growth at all cost and funding rounds and driving valuations and so on. We were lucky enough to start in 2023. So we had to, from day one, to really focus on this alignment with all of our portfolio companies, to really focus on unit economics plus growth, but to do it in a very, I would say, fundamental-driven way.
Yes.
Yeah.
Thank you so much for sharing that. And then, same question.
I would love to 100% agree, and I would add on that is just they must agree and align on the decision principles. Mm-hmm. Like when things are growing, revenue is growing, everything is good. But when the pressure hits, decision principles has to be in place. That's one thing. The second thing, I would believe things has to be a little bit clear from the beginning, especially what I love to call is the unspoken assumptions. There are a lot of assumptions that happens between an investor and a founder. A lot of them is unspoken. Like sometimes the investors think that the founder is very realistic. On the opposite side, the founder thinks that the investor is patient. So the unspoken assumptions has to be clearly set before everything goes.
Thank you so much, Seif. So how do you know which of those topics should be spoken early on? Like, what are some of the spoken points that you make sure to cover?
100% how decisions moves. From a governance standpoint, and not only structural governance, emotional governance as well. Because especially in the growth period, there is a lot of pressures. So these things has to be set on the table before anything happens. Decision principles, emotional governance, these are the key ones in the beginning has to be set.
Thank you. So Seif, I'll maybe ask you the next question. I would love to know, at what stage of growth did investor alignment become make or break for you?
I believe it's going to be very important when the growth stops to be exciting and it becomes more of a complex thing. So these are the things, it's going to be a make or break.
Yes.
So this is the area where, for me, it's a make or break. It's just when the growth's not exciting as before and becomes more complex. And now we see the decision starts to shift from growth, I would say, towards speed, towards structure versus like control. This is the area which is very critical.
Thank you. Khaled, can I ask you the same? At what stage of growth did investor alignment become make or break for you?
Actually, I agree with Seif. I think when things aren't going really well, I think this is the most important, or we ask ourselves and we start to ask the difficult questions. Also, I believe that from the early beginnings, I think it's very important. We need to define what growth or how success looks like for the investors and for the founders. I think this alignment from day one, defining growth, is it margins, is it sales, is it market expansion, or is it something else? So defining growth and how success looks like from day one, I think it's the most important factor in the journey. And definitely, as Seif is saying, it becomes really a make it or break it decision because when things aren't going your way.
Thank you. And a follow-up on that, did either of you ever have to learn the hard way about betting on a capital partner beyond the check size? Something you learned that really was make or break?
Of course, the hard way which was learned that you do not need to vet a capital partner based on I would say, the check size. It's very important to bet from a perspective of their behavior, of how they act under pressure. When things go wrong, what happens? They become in control, they get into it, they lean in or they control, they panic. There are a couple of things more behavioral, which is more important, I believe, than the check size itself.
Thank you. So question for Ali. How should growth capital be deployed differently today toward capabilities, leadership, infrastructure, rather than purely customer acquisition and value acceleration?
Yeah, this is actually exactly what we mentioned before. It's the deploying to really build a sustainable business rather than just user acquisition and burning cash. So what's actually investors are focusing on today when they deploy actually is how to build a solid fundamental business rather than just doing a lot of like funding rounds and trying to expand without, I would say, a fundamentally based business.
So how can you tell the difference? Like, what specifically do you look for?
We look for like the founders for sure. These are like the most important thing. And then you look at the traction, the unit economics of the company itself. Did they reach to a product market fit or not? Use of proceeds, where the capital will be actually used. So these are like kind of the building blocks that we focus on.
Yes. And so with the benefit of hindsight, you've had incredible experience. If you knew everything you know today, what would you use to choose that perfect founder?
A perfect founder, the transparent one, the one who's like really transparent in everything. Because for sure you will have a lot of difficulties across the journey. So you need to have a founder that is pure, transparent, sharing everything with you.
Mm-hmm. And have you had an experience, without naming any names, where you didn't have that? And when did you find out in the journey?
It's when you start talking about cash flows, right?
Yes.
So once you see like the company is actually in a very bad situation and there is kind of a runway, like a very short-term runway, and it's kind of a surprise for you.
Yes. Thank you so much. And so maybe let's chat about what are some realistic insights specifically around alignment later in the process? So you can have alignment at the beginning where you have almost that broker negotiation around what you're trying to create together. But then the business grows, things change. So how is that process brokered over time? And does it change? Or do the rules you establish at the beginning continue on longer?
I believe in, like, this is life, things change. Either the macroeconomics things changed or the capital cycle tightened. The most important thing, as I mentioned in the beginning, is the decision principles. When things changed, how we will act.
Yeah.
There is a way that to become defensive and attacking, and a way you say like, okay, this things changed. These are the trade-offs that we have, what we will do next. Versus, you promised me this, it failed, and it becomes defensive. So, given things will change, the decision principles, and also one thing which is very important, we always plan on the best case scenario. So when everything is good, this is the best case scenario. But we also need to plan for the downside, the what if protocols. What happens if things changed?
And what does that look like? And when would you talk about the downside? Because I invest as well. I've worked with a lot of companies in different capacities. And the issue is at the beginning, everyone has big dreams. Every company is going to be a unicorn. Every investor is going to have that massive successful exit. So when do you talk about what could happen with the downside?
Early, I planned the best case scenario. And at the same time, we plan for the downside. What's going to happen if things didn't move as planned, which is the what-if protocols. If it didn't go that way, the decision principles will be that things and will be more collaborative rather than a defense and attack way.
Thank you.
Yeah.
And I would love to hear from both of you, do you handle that downside conversation? How do you do it? What does it look like?
Yeah, 100%. Actually, we run different scenarios with all our founders to make sure if things went rough, how can we react to it, whether from a fundamental perspective, funding perspective, and so on.
And what are some of the most common ways that the companies end up failing? Like, does it actually reflect the model?
Yes, but there is, for example, Corona is something that is unexpected, right? In Egypt, a couple of macro dynamics that happened. So there is things are kind of outliers, but you need to find solutions.
Thank you. So I have a question for Seif.
Yeah.
The UAE ecosystem is designed for rapid scaling. Does that environment create a hidden pressure to spend?
Of course, UAE promotes, or it's actually the infrastructure for speed, 100%. And that's the competitive advantage, of course. But we need to think about speed without discipline. Put pressures on scaling, maybe the business is not ready for this. So I believe that the hidden pressure is not about spending, the hidden pressure is about being visible more, okay? Which means it's very good to have speed because it will reflect on the culture of the company, but at the same time, discipline has to exist. Because again, at the end of the day, success is not only about speed, it's about sustainability. So if you grow without discipline, when you're not ready to scale, you will crack. And that's not what we want at the end.
And do you find that the founders or investors have that discipline at the beginning, or it's something that grows together?
It depends from case to case and from person to another, 100%. Somebody's always, usually, I would say, investors, founders have a lot of belief in what they're doing, so they want to scale faster. But it's a case by case.
Yes. Thank you. And Khaled, in business with physical supply chains and operational complexity, why is scaling enterprise readiness, systems, cost control, and customer experience often more important than rapid geographical expansion?
It's a great question. I always say it I think growth is easy. Anyone can grow the business. However, I think what's really challenging for businesses is creating the machine for this growth. And what I mean with the machine is the supply chain, the systems, delivering real value to your customer and perfecting the customer experience. So in our case, we've been operating for 10 years. It took us 8 years to build the systems, and we expanded in 4 different markets in 2 years. That's why I think premature expansion, either locally or geographically, without having the machine, the operations machine that can support this growth, will only result in customer frustration, will multiply your problems and your challenges, and eventually this will turn not in a very good way. However, if you perfected the machine and you created the right machine behind the growth, I think then this is when you're ready to grow geographically and replicate your story in different markets.
Actually, to add to what Khaled is saying, one of the main things that we try to work with our portfolio companies is to actually build or to lay the foundation to growth. So sometimes you have the opportunity, but you're not ready to it. So we need to make sure that the company is ready to scale enough.
And so what are some of the things that you do for readiness? Like, is that something that is invested in all the companies in a standardized way with the physical systems?
It's case by case, right? So for example, there are companies that need to hire specific second layer to really for the founders to scale further. Sometimes it's systems, sometimes it's even a commercial thing. So it's case by case, but you need to make sure that you're ready to do it. And to for example, going geographically, you need to master the home country first and then go outside. So there's a couple of things that we focus on when it comes to scaling for sure.
And how far does a company have to go in terms of success in their home country before you'd feel comfortable supporting them scaling outside?
In our opinion, you need to be self-sufficient. So cash flow positive, there is no any risk on the home country, and then take additional funding or whatever to scale for new countries. But at least your home country is very solid, profitable, and your worst case scenario is going back to your home country.
Thank you. And Khaled, I saw you nodding. Did you want to add to this?
Yeah, I think I agree. Definitely, I agree with Ali. You need to make sure that the fundamentals is right. So there is no right or wrong answer on when. So if the machine is working, then there's no right or wrong answer when is the perfect time to expand geographically. But I think if you have your fundamentals in place in your home country, which is your P&L, your balance sheet, in a healthy status, then you think you have a great opportunity expanding out of your country, then I think it's probably the right time to expand.
Thank you. So in our last 2 minutes for this topic of the value of growth, aligning venture capital with enterprise vision for shared success, do you have any other advice for the audience?
I believe also one of the main critical things is to agree on the exit. That's very important because every capital has an exit, and it's better to match yours as a founder. So let's give an example. If the investor is success for him is 5 years flip, and you're building a 15 years company, that's an absolutely misalignment. So that's a critical thing. Plan for the exit as well.
Thank you.
I believe I think having an investor on board is like marriage, and I think getting married to the wrong person can ruin your life. I believe you need to choose the right partner, because they are partners. In our case, when we partnered with Beltone, I couldn't see any other way. So basically, if we had the wrong people on board, then I think we'd be risking our whole business. So you need to spend a lot of time choosing the right partner, choosing the right investment, and the second step is align on basically how success looks like.
Thank you.
I totally agree with both of them. The only thing for founders is just build a sustainable business and all options. You get a lot of options. Just
Thank you so much. So some of the insights I've gained are that there are some common practices that need to be fulfilled. We need to align on decision criteria, growth criteria, discuss the good and the bad in early days. We also need to tailor and personalize, because while there are some best practices, investing in our home country, getting a solid foundation before growth, there are also so many differences company to company that need to be considered. So I'd like to thank our panelists, Seif, Hakim, Khaled, Attallah, and Ali Mokhtar. Thank you so much for your time and insights.
Thank you very much. Thank you.